Welcome to CFA Level 1, Equity Investment, Study Session 12 and 13. In this reading, there is a total of 12 learning outcomes, and it has been summarized into 5 major parts: financial intermediaries, market classification, position, transaction process and market instruction. With that, this slide is to explain different type of financial intermediaries. Arbitrageurs are those buy and sell simultaneously, to take advantage of mispricing. For example, the same company traded in a different exchange could take advantage of pricing inequality. In securitization, for example, borrowers borrow loan from the bank to finance their housing. Bank, in turn, could securitize the housing loan into tradable securities and sell to investors. With more funding from investors, the bank could finance more housing loan. This type of question is to test your understanding of various financial intermediaries. Again, arbitrageurs buy and sell the financial asset in different markets to profit from the price differential. Primary market is where the company raise money for the first time. Secondary market is those company that has been listed and seeking to raise fund in the stock exchange. Another differentiation is to compare the duration of the instrument. Money market refers to the investment of less than 1 year, while capital market refers to the investment of greater than 1 year. Traditional market refers to conventional investment instruments such as the equity market, the bond market. Alternative market refers to all other such as real estate investment. Equity share can be sold publicly, privately, etc. Private placement is to sell the share to the qualified investor. To be a qualified investor, investor need to at least fulfill some of the criteria, such as net worth. For shelf registration, it allows the company to sell shares without selling all shares all at once. For right offering, it gives existing shareholders the right to purchase shares. This type of question is to test your ability to differentiate financial execution such as shelf registration, right offering and IPO. And again, right offering represents share issuance to existing shareholder. When investment bank assists company in public offering, it can provide underwriting offering, in which investment bank guarantee sales of share. The guarantee come with a cost, and generally lead to lower price offering, in order to fully allocate to their clients. In the best efforts, investment bank has no obligation in the public offering. Therefore, investment bank is to solicit in selling, that generate the most commission. In the secondary market, equity shares can be traded via order-driven, quote-driven, and brokered market. In the order-driven, trades are matched with willing buy and willing sell. Match pricing is the primary concern. In the quote-driven market, it requires dealer to quote the price. Therefore, dealers are said to provide liquidity. In the brokered market, it referred to block or unique assets such as real estate, that require broker to facilitate the trade. In the call market, all prices for bid and asks are gathered, to generate to ensure demand is as close as supply. In the continuous market, shares are traded continuously. Long position is known as owning and holding the asset, therefore taking advantage when price increase. In contrast, short position is the borrowing the asset and would return to lenders in the future date, therefore taking advantage when return the share at lower price. Leveraged position is to borrow an amount in the purchase of equity. The interest rate for the borrowed margin is also known as call money rate. The equity share being bought would change in value, however the amount of loan is a fixed amount. To the lender, the drop in share value would increase credit risk, and therefore, impose maintenance margin that require equity share to be maintained at certain value. For price fall below the value, which is known as margin call price, an investor is required to top up value to the maintenance margin. Having able to recall the equation in previous slide would help us to answer the margin call price. This slide is to explain how to trade and when to trade. The most common is to market and limit order. Market order has trade efficiency, because buy or sell trade are to execute immediately. Limit order has cost efficiency, because buy or sell trade are to execute if it reach the trigger. All or nothing order is that it do not allow partial fulfilling the trade. Hidden orders are orders not be perceived, while iceberg order is to allow partial disclosure on trade. Trade could be last one day and known as day order. Good till cancelled order is to trade continue until it is completed or cancelled. Stop order is also triggered by share price. This slide is to illustrate limit order and stop order. In general, stop order execute the order in anticipating the rising and falling of the price. Meanwhile, for limit order, it execute the value buy or sell, and believe the trend would reverse. We have different definitions of prices, gathered from buyers and sellers. To take the market, one needs to take the best bid or best offer available. Make a new market is to create the best available price. In this practice problem, it intended to check your understanding on price and trade instruction. Welcome to CFA Level 1, Equity Investment, Study Session 12 and 13. In this reading, there is a total of 11 learning outcomes, and it has been summarized into 3 major parts: index measurement, index features, and rebalancing and reconstitution in indexes. Price index only include price, while return index include both the price and reinvestment incomes, such as interest, dividends. Price index only include price, while return index include both the price and reinvestment incomes, such as interest, dividends. In the price-weighted index, it is the sum of stock divided by the number of stock. At time 0, the sum of stock is 12, and divide by 3 stocks, that give us the price-weighted index PWI of 4. At time 1, the sum of stock is 18, and divide by 3 stocks, that give us the price-weighted index PWI of 6. Dividing time 1 to time 0 would be the change in price-weighted index. In price-weighted index, the index would need adjustment for stock split and affected by high-price stock. This slide is an example to explain how price-weighted index can be affected high-price stock. For example, for a 100% increase in stock A, holding stock B and C unchanged, the index would increase by 16.67%. For example, for a 100% increase in stock C, holding stock A and B unchanged, the index would increase by 50%. For the same increment in stock price, index is higher when stock C increase. In the equal weighted index, it assumes equal investment in each stock, and we need to calculate holding period return for each stock, and measure an arithmetic mean and geometric mean. It measures the return rather than the price, and therefore not influenced by price. However, earning volatility and holding period return HPR, especially in small capitalization stocks, would impact the equal weighted index. In the market value index, market value is measured as stock quantity multiplied with price. For example, market value for stock A at time 0 is equal to price of 2 multiplied with number of stock 100, and the market at time 0 is 200, and market value at time 1 is 300. The sum of market value for all 3 stocks at time 0 is 2,800, and increased to 4,300. And the index has increased by 53.57%. Market value index is affected by the large market capitalization stock. In the float-adjusted stock, the calculation is very similar to market capitalization, except it is multiplying the price with non-restricted share. Non-restricted share is tradable shares and is equal to total shares issued minus locked-in shares. In the fundamental weighting, the index is weighted using economic fundamentals such as dividend payout ratio. Using fundamental weighting could lead to trend toward value stocks, as weighting is trending favorably toward high dividend payout ratio. Fundamental weighted could bring contrarian effect. That is, increase in price would lower the dividend payout ratio, and lead to lower weighting. The question to test you differentiating different indexes. This slide is to highlight various type of equity index. When matured bond is replaced by new bond, the index is adjusted. That is explained by the large universe of securities. Fixed income market is generally the dealer market, and is an infrequent market. The commodity index is constructed using the future index. In the real estate index, the appraisal of the property is not as frequent. And therefore, the appraisal could underestimate the risk. When property has no much repeat sales, it is difficult to indicate the proper price for the property. Right is tradable security in the stock exchange. In measuring the hedge fund index. In here, hedge fund index is less regulated, and that could lead to biases in index reporting. In the survivorship bias, is to explain terminated or close hedge fund is not included in the index. What's remained is those performed well and included in the index, and that is survivorship bias. In the backfill bias, is to explain well-performed index is included in the index. The index of SAND 500 would assign weighting in each stock. Change in stock value would impact the index. And change in percentage of weighting is known as rebalancing. Add or remove stock in an index is known as reconstitution. You can refer the Tesla's inclusion in SAND 500 as the index reconstitution. Welcome to CFA Level 1, Equity Investment, Study Session 12 and 13. In this reading, there is a total of 7 learning outcomes, and it has been summarized into 3 major parts: forms and explaining market efficiency, anomalies, and behavior finance. This slide is to summarize the 3 forms of market efficiency, which are weak form, semi-weak and strong forms of analysis. The weak form of analysis only has the available market data such as price data, and using technical analysis cannot generate abnormal profit. Fundamental analysis can generate abnormal profit. The semi-strong form of analysis, both technical and fundamental analysis to analyze market and public info, would not be able to generate abnormal profit. Using private info can generate abnormal profit, but that is not allowed in regulation and CFA. In the strong form of analysis, all information cannot generate abnormal profit. This slide summarizes the weak, semi-strong, and strong form of analysis. For example, the January effect, investors tend to sell in December and buy back in January to reduce tax. For momentum effect, short-term increment would generate longer-term increment effect. Size effect, small capitalization stock tends to outperform large capitalization stock. And value stock tends to outperform growth stock. Other observations include close-end, earning announcement, IPO and economic fundamental, that could impact stock prices. In the loss aversion, investors place greater value to 1 unit of loss than 1 unit of gain. In the overconfidence, investors overestimate good news. In the representative, investors misrepresent good companies as good stock. For example, investors who prefers value products from Walmart would prefer Walmart's share. However, the preference towards the products has no indication to the stock price. In the gambler fallacy, investors believe the previous outcomes would impact the future. For example, in tossing the coin, if one believed the past 4 outcome of tails would impact the next toss, that belief is said to be gambler fallacy. In the mental accounting, investors classified investment into different account, rather than the total portfolio. For example, investors separate different investment account for different purpose. An investment account for children education, another investment account for retirement. Conservatism, investors reluctant to change, despite of new information. In the disposition effect, investors tends to sell stock increase in value, and retain asset that is losing making. The reason because, investors do not want accrue loss.